it's refreshing to have somebody like you come out and say, "Oh, I think they can do much better." And it's humbling to see at the end of the year that you were right and we were wrong. So you were seeing something that we didn't see, and I love that dialogue and I welcome it.
So this clip is from Daniel Schreiber, Lemonade's CEO, and it's from a recent interview I did with him, which I'll link up above and down below if you haven't seen that yet. But he gave me some great kudos here. It says, hey, you know what? Actually, for 2023, some of your own predictions were closer than our own guidance was. And basically, a year ago, I had said I thought they could maybe do adjusted EBITDA of $175 million. That should be loss in 2023 instead of their guidance at the time for a $240 million loss. And they ended up doing, actual result was $173 million loss. So obviously, some of those sort of rough math and predictions I was doing came out to be true. I think, though, there was definitely a lot of luck in that calculation, so I'm not going to take all the credit for that. Or in this video, we're going to be looking at 2024. I'm not going to suggest that, hey, these numbers are going to be perfect, as there's a lot of assumptions we have to make to try and build out a model. But I want to show you that at least up front to say, hey, last year we were looking at this, we did pretty good. Let's see how we do now for 2024. So for 2024, management guided a $942 million of in-force premium by the end of the year, and adjusted EBITDA loss over the full year of about $155 million loss. So some pretty key numbers, $942 million, looking at the higher, the better end of both those spectrums. $942 million in-force premium, $155 million loss. So if we're looking at our model, one of the first things we want to estimate is what might the customer count end up at? What might the customer count grow to? And from the Q4 letter, we had this line that said, that's why we plan to roughly double our growth budget in 2024 from the $55 million spent in 2023. So from that line, we can assume, hey, their customer acquisition spend is probably going to be about $110 million in 2024. So then the next thing we need to think about is what customer acquisition average cost will Lemonade have to spend for each customer they acquire. So here's a graph that I've put together. This is part of my Lemonade model. If you want to support me on Patreon, I will link that as well down below in the description, and you get full access to this model with my Patreon. But in the last, it's varied some, generally between about $100 per customer up to even, in the $150 higher, but generally between kind of $100, $140. In the last 4 quarters, as Lemonade's sort of been more pushing into renters and pet focused, which are products, they're going to be less competitive products. You're not going to spend as much customer acquisition cost to acquire a customer. They've been at $109.7, $80 per customer, $98 per customer, $123. Some of this is also seasonal. Q4s can tend to be a little bit higher than, say, Q3, because Q4 you're spending more ad dollars against others that are advertising, for Christmas time, where there's a bigger ad spend in general by the market. So there's a little bit of nuance there, but around in that range. Pull this up, we can see here on my model, over the last 4 quarters, it's been an average of $104 million, or $104 per customer. So I'm assuming about $110 going forward over 2024, over this year. Could get higher in future years as they push more into home and car, but for this year, I'm still expecting about $110 per customer. So if we know they're spending $110 dollars per customer, and they're spending $110 million on customer acquisition costs, well, you get 1. The answer is 1. You're going to have about 1 million customers acquired over the year. But of course, of those 1 million customers that are acquired, a number of those customers are going to churn away each quarter. So you also have a churn rate, what I call churn from 12 months prior, and you can see the last few quarters was 16.8, 17.8, 19, 21. Used to be really bad a few years ago. This was a major talking point in the Lemonade community when they were more exclusively just sort of renters insurance. Vast majority of their customers being renters. They were even 30% kind of range. Now they've been continuing to improve that. They're at 16.8% for my calculations in the last quarter. So I've taken 16.8% of customers are churning on a 12-month basis. So each quarter, a certain amount of those customers are going to churn away. And I have a bit of a summary sheet here on this one tab in my model that I'm going to kind of just help explain my assumptions, help summarize my assumptions for you guys so you can follow along a little bit easier. So 2023, I have the Q4 numbers. Then we're going to look at other things as well, like premium here right away. But for customer count for this year, here's what I'm thinking. So I'm thinking, hey, every 12 months they have this churn rate, and I'm thinking, hey, over the whole year they're going to acquire about 1 million customers. Generally in Q3, those customers they acquire more. It's the biggest push. Generally Q3 is the biggest for them. So I'm doing 333,000 customers in Q3 and 222,000 in the other 3 quarters. Together that sums up to almost about 1 million customers that are acquired. So and then the math looks like this. Each I'll show you this really briefly here. So each quarter over quarter, if we're looking at Q1, you'd take the previous quarter's customers multiplied by 1 minus the churn rate to the power of 1 quarter. That gives you a quarterly churn rate, and then plus the new customers that come in the door. So you do all that math. This is customers of your current base that churn away. Then you add the 222,000. You get about 2.16 million customers. So 2.16 million. You do that 3 more times, you get to about 2.6 million customers at the end of Q4. So I flip back over to the model. Last year we ended just over 2 million. The year prior we were at 1.8, so we added a little over 200,000 customers. So major growth year, which they're talking about doubling growth spend. We're going from 2 million to 600, over around 600,000 customer increase in the sort of total customer count. They're actually going to gain maybe more like 1 million customers, but of course the number of those customers are going to be churning away as well. Now let's think about in-force premium and kind of calculate this completely separately from the customer count, and think about okay, what are the main sort of key drivers of in-force premium? What are those key drivers? So if you think about it, there is one factor, one variable is, hey, they're increasing the prices of their book and of their policies, and then as those policies, as they're renewed, those prices kick in, and they slowly, just naturally on the current book of business, have an increase in premium. So I'm averaging about 25 million over each of the 4 quarters, which if you pull up their Q3 letter from last year, it said one line from that letter, important line, said further rates await regulatory approval. So during 2024, we expect to earn an additional 100 million from increased rates. So I'm saying, hey, let's just split that evenly. Each quarter, they're going to make 25 million in premium. If they did nothing else, 25 million roughly in premium just comes in the door. Next would be what I'm calling non-renewals, especially home non-renewals. If you watched my recent interview with Daniel, I asked him about what their strategy was in home non-renewals, and he said, hey, if we have rate increases that are coming in the next few months, we might hold on to a customer. But some customers we're not certain when those rate increases are going to come online. They're taking way too long. And they might actually non-renew those customers and prove, hey, we can't insure them at the current price that regulators are allowing. And he mentioned in my interview that they had talked about this in the Q2 letter. So the Q2 letter, he said already around 2,000 homeowners policies have been non-renewed. And then he mentioned many more in my interview with him. So I'm assuming, hey, 2,000 policies happened in Q2. Maybe they're $2,000 per policy. That works out to about $4 million in premium that is non-renewed. If I jump back to the right tab here, so I'm assuming they're just going to keep doing that. $4 million each quarter comes back out non-renewed. It's hard to say because in that interview I did with him, it kind of sounded like by the end of this year they would be rate adequate in home and car in just about everywhere, he said, other than maybe some pockets here or there. But So it's hard to say. Maybe this is actually a little conservative. Maybe by the end of Q4, why would they be still taking 4 million off the books or waiting even that long to do that? So I think some of these numbers, if anything, are a little bit on the conservative side. But again, 4 million out of premium each quarter from non-renewal of home customers. Then I'm saying, hey, of these 222,333, these new customers coming in the door, I'm saying they're going to come in the door at a certain new customer average premium per customer. Those customers coming in the door, of course, are bringing a certain amount of premium with us. Now, where did I get 294 from? If we go back to my model and I go all the way down here, I look at, I had some math here I'd done in the past based on, I kind of reversed engineered this IFP calculation that I'm doing to say, hey, for different natural bundling cross-selling rates, these are different bundling cross-selling rate, sort of upselling within the book. For different average rates, and I think 2% is kind of a good number, could even get better in future quarters as they really kick home and auto or home and car really ramp up. But for different rates, I calculated what the new customer premium per customer has been. It was higher in the past when I think they were pushing maybe more home and car customers, and then the last year they've really pushed more probably pet, more renters customers is what they've been more focused on for the time being. So within that, for the 2%, you take the average of those results and you get average of 294. So that's where I'm getting that 294. I'm saying, hey, every new customer is not coming in at the current premium per customer, which is a little bit higher, but they're actually for the 2024, partly because they're only spending $110 per customer. Again, they're getting more renters, more pet customers as sort of a broadly speaking. Then you have a little bit lower premium per customer. So could be higher, but I'm going 294. And then I'm saying this cross-sell rate is 2%, saying, hey, the whole book of business, 2% per quarter. Every quarter, the current book kind of grows by 2%. We had some numbers on this. Back in the Q2 2022 letter, it talked about Illinois versus the rest of the book of business and was showing about, if you did some math there, about how much was gaining from premium, gain from cross-sells. You get about an average somewhere between 1.5 to 2.5 of premium per customer increase from cross-selling. So I'm going with 2%. I think is a good value to go with, because as there's more home, as there's more car customers slowly come on, this number should get even better, maybe even 3% in future quarters or even future years. And then again, I'm going with customer churn of 16.8%, taking that out of there. So what does that calculation then look like? If you look at it just for Q1, for example, I have the math here. It shows, well, here's your previous premium of the previous quarter. You had 25 million that's earned in. 4 million is lost from home non-renewals. You had the 222,000 new customers at their new premium rate. That whole book of business then grows in the quarter by about 2% just from natural cross-selling, upselling, and then that whole book of business loses a certain percentage because a certain amount of all those customers drop out. And you get to about 811.7, or call it 812 million of premium. And I will pull that up right there, 812. And if you do that for the next, all that math, again, 3 more times for the next 3 quarters, you get 812, 875, 972, big push there because there's more customers joining in Q3. And then Q4, about 1,021 million in IFP. Again, this is versus their own guidance of about 942 million. So still, I think, a fairly significant beat, not as significant as maybe 2023 was, but still, 1,021 over 942. It's about an 8.3% improvement in what the high-end case could be. So still, I think a really significant beat. I really think there's a good chance they get over $1 billion. I would really think internally they're probably even thinking, hey, let's get to $1 billion in 2024. Let's push for that. We're hungry for that growth. as Daniel said in my interview with him, they're hungry and they want to do the very, very best they can. So I think there's a good chance they do over $1 billion in IFP. Then finally, let's talk about gross loss ratios. So gross loss ratios, I'm thinking about it like this. I'm saying, hey, what's the gross loss ratio X cat event at X without catastrophes included? We know that in Q4, there was this nice graph right up here that showed, hey, it's been about 72, 73, 72% in Q4. So roughly, I'm saying, hey, Q1, maybe it's still 72%, let's just say in Q1. But then I'm saying there's going to be a rate increase effect. So as rate increases earn in, this say 25 million, that's going to improve this whole scenario by a factor of 0.97, or about a 3% improvement in gross loss ratio X cat. So that's naturally, and that improvement's going to carry forward into future quarters because you just added more premium in for no extra cost. So that should naturally just keep improving your overall gross loss ratio X cat. But then I'm saying, hey, inflation is still there, still prevalent. Cost of repairing homes and cars is still expensive. So I'm going to say there's an inflation effect that brings us down by 1% per quarter. Maybe 1% per quarter is too high, but I'm trying to skew a little bit conservative here in the numbers. So 1% per quarter is what I'm saying. And then catastrophe effect. So last year, for reference, there was, if you look at that graph and you take the difference between the pink line and the blue line, you get these values right here, 15, 21, 10, and 5% for LMND. Basically what their catastrophe event effects could be. And I've taken those numbers and basically made some improvement upon those and said, hey, let's say maybe Q1 they do 10% cat event, a little bit better. Maybe Q2 it's 15%, not quite as bad. There's not as much of a catastrophe, not as much as the windstorms, I think is what last year made that quarter quite bad. Again, this quarter 8%, 2%, and and that's partly maybe they're more into renters, more into pet. They're non-renewing those, poor home customers that are maybe in bad spots. So you'd assume there'd be some improvement. So that's what I'm going with for this year. And it's as simple as, 72% times by this factor, and then adding in 1% and 11%. It would be the math on this. And that gets you to a gross loss ratio. Let's reset those of 81% in Q1, 84, 75, and then 67% in Q4. So good improvement from the year-over-year numbers. But that's kind of roughly what I'm thinking. So you plug all these numbers into the model, 2.62 million, 1 billion, 21 million, 67%, and all the other values. Plug all those in. We'll scroll back up to the model, top of the model here. Get those values here for customer count, for IFP, for your gross loss ratio here. And then otherwise, I'm keeping things fairly similar. I have their synthetic agents at about 80% of the CAC spend, covering about 80% of that cost with that sort of a line of credit that they offer. Other insurance expense I've grown at a similar rate that it's grown in the previous year, so about 4% per quarter. But it's as a percentage of gross earned premium, it is continuing, like most expenses lines, continuing to track down from 9% to 7%. And then tech development, I have completely flat. It actually went down, from Q4 of last year to the year before. It went down a little bit, but I have it flat. General administrative, I also went down a little bit from the year before, but I have it flat again. That gets you total expenses, or expenses as a percentage of GEP, or expense ratio, from 50% in Q4 down to about 43% at the end of 2024. Some other things, stock-based compensation, $15.5 million, and it gets you to adjusted EBITDA of about, let's see, for the full year, $146 million loss. Adjusted EBITDA minus 146, somewhere in that ballpark, I think would make sense for 2024. Again, this is versus their guidance of $160 million loss to $155. So not a huge difference between those two, but not as, I don't think, quite as huge a difference as there was at 2023, but still a significant beat. And I think there's actually some good reasons to believe this might be conservative. So first of all, scaling could lead to a compounding word-of-mouth effect, improving customer acquisition cost efficiency. So, if you're at 1 million customers total versus you're at 2 or 2.6 million customers total, it just means you have more customers that could effectively tell about their good experience to somebody else and spread the word of mouth of your product to others. And then that means your new customers that are coming in the door, that could lower the overall cost for the customers acquired. So that could be sort of a scaling effect. We might start to see that could improve things. We also accounted for 1% quarterly inflation effect on the gross loss ratio. This could be too high given potential inflation slowdowns this year in 2024. So that's, definitely a possibility. We allowed basically 1% a quarter. Maybe that's too much. Our projections for customer churn and annual dollar retention are based on, what's historically been there, but recent trends, it's been trending in a positive direction for, several years, both these metrics, customer churn and annual dollar retention. So it could definitely see that this becomes better than what we were modeling for in those levels. And then average premium per customer for new customers, I was calculating and estimating about $294. But hey, if they start expanding home, maybe later this back half of this year, even 2024, for home and car, and they start to creep that up, then this number could be a lot higher for those new customers that are coming in the door. Again, I think we're a little bit on the I'm trying to be accurate and slightly conservative, anything in our thinking here. So then we allowed $4 million per quarter of IFP losses for non-renewals of especially the home product. This might be too low, too high. It's really hard to say, but I do think as they limit the amount of non-renewals, I do wonder if they may limit actually the amount of non-renewals this year if they think they're going to be mostly rate adequate by the end of 2024. So like Q4 of this year, we allowed another $4 million loss or subtraction, but why would they be subtracting those, say another 2,000 customers of home customers that quarter if they think they're going to be rate adequate soon? So all those reasons together, I do think, if anything, this beat that we're showing and planning for here could be a little bit conservative. And you might be wondering, why does any of this even matter? But if you look at a graph of adjusted EBITDA, it does matter because we're continuing to trend towards zero and in a positive direction. And I really think eventually this graph is going to sort of take off like a hockey stick in the positive direction. Ever since Q3 of 2022, which management said was going to be one of their worst quarters ever, which it has been. They said that would be sort of the turning point. It has continued to improve, and so if you look at it, hey, over the last 4 years, or last year they did minus 170, and then over 2024 they're going to do minus 140 or in that range. And of course, if we flip out to a larger graph of showing future years, then hey, we might hit a 0 point somewhere around the end of 2025, 2026, start getting positive. And I really think Lemonade's built for scale, for growth, that this graph could really turn into that hockey stick, where it has the base and then takes off in a vertical line. I'd love to hear what you think, though. Let me know in the comments down below what you think of this sort of potential 146 million adjusted EBITDA for the year and IFP of over $1 billion, let's say $1.021 billion, and customers of 2.6 million customers count. Does that sort of fall in line with what you're thinking, you're expecting? I would love to hear your feedback. So let me know down below. Shoot me a message. Thank you so much for watching, and remember, it's in the bag.